Yesterday, something extraordinary happened. Gold, the world's oldest store of value, fell off a cliff. Silver followed. Billions of dollars vanished from portfolios in a single trading day. And almost nobody saw it coming. This wasn't just a dip. It was a full-blown meltdown. The kind of move that rewrites narratives and humbles everyone who thought safe haven meant safe. For months, gold had been unstoppable, breaking records, defying gravity, climbing past $4,300 an ounce. Silver was tagging along, the faithful shadow in a metallic bull run. Analysts called it a new era for precious metals. Investors called it insurance. But on October 21st, the market called their bluff. As Asia opened, something fell off. The yen was falling. Stocks were rallying. Traders smelled optimism in the air, the kind that kills fear trades. Then came the headlines. U.S. China trade tensions easing. Government shutdown nearing resolution. The words that usually calm markets, but crush gold. By mid-morning in London, gold had already slipped 2%. Silver was cracking below $48. It was quiet, too quiet, until the New York session opened. And then the floor vanished. Futures traders were the first to hit the exits. Margin calls piled up. Stop losses triggered in a chain reaction. At $4,100 per ounce, screens turned red, and a decade of faith in the eternal hedge suddenly looked fragile. People forget gold doesn't crash because of panic. It crashes because of complacency. When everyone believes the same story, that gold always rises when things get scary. That's when it's most vulnerable. And yesterday proved it. Behind the curtain, the signals were already flashing. The dollar was strengthening, quietly up almost 0.5%. Real yields ticked higher. Equities were rallying, oil was stable, and volatility was asleep. The world had decided risk was back in style. And when risk is in, gold is out. ETF outflows confirmed it. Massive redemptions hit GLD and SLV, billions pulled within hours. COMEX futures volume doubled as speculators dumped contracts. Open interest collapsed. This wasn't fear. This was forced selling. Leveraged players clearing the decks before their brokers called again. By late afternoon in New York, gold was down over 6%. Silver had cratered 7%. Traders called it the biggest one-day fall in more than 10 years. And still, the mainstream media barely noticed. But behind every tick, there was blood. People who chased the rally were wiped out in hours. And here's the twist. Nothing truly bad happened. No war, no banking collapse, no inflation shock. Just a collective realization that the story had run too far. Gold's rally had become its own risk. Let's talk psychology. Every market cycle has a climax, that moment when logic bows to emotion. In gold's case, that moment was the $4,300 euphoria. It wasn't fundamentals driving it anymore. It was faith. And faith is volatile. Technically, the chart was screaming exhaustion. RSI off the charts. MACD divergence building for weeks. Then the break below 4,300 triggered automated selling. Below 4,200 stops fired. Below 4,100 panic trading turned mechanical. Momentum doesn't care about belief systems. Meanwhile, the macro machine was turning. Treasury yields slipped, but not enough to justify gold's altitude. The Fed was signaling rate cuts, but cuts born from confidence, not crisis. That's bad for fear assets. Even the VIX yawned. This wasn't risk-off. It was profit-taking dressed as a crash. But look deeper. There's a bigger story, one that started years ago. Central banks have been quietly loading up on gold. China, India, Turkey, all building reserves. Retail investors followed, thinking they were front-running the big money. But when central banks stop buying, even briefly, the vacuum is brutal. Yesterday may have been that pause. Then there's the derivatives trap. Options desks were overloaded with calls. As prices fell, dealers flipped their hedges, selling into the decline. That's how crashes feed themselves, not from fear, but from structure. By the close, the damage was historic. Gold down 6%. Silver down 8%. Platinum, palladium, miners, all dragged into the pit. And yet, the dollar barely moved. The S&P closed flat. Crypto dipped less than 0.5%. The message? The world just stopped needing a safety net for a day. But markets have memories. Every violent correction leaves scars and opportunities. If history is a guide, gold doesn't stay down for long. Corrections like this often reset the board before the next leg up. The key question isn't, why did it crash? It's who's buying now. Because while retail panic sells, smart money accumulates. They know that fundamentals, deficits, debt, de-dollarization haven't gone away. They just went quiet. What happens next depends on data. This week's U.S. CPI report and the Fed meeting will set the tone. If inflation flares, gold rebounds. If yields stay tame, we might see consolidation near 4,000. Either way, the next move won't be small. Think of October 21st as a stress test, a reminder that no trade is invincible and no asset is sacred. Markets reward discipline, not faith. Gold just reminded the world that even safe havens bleed. So the next time you hear someone say, gold never crashes, tell them about yesterday. Tell them about the day the metal cracked under its own legend. And tell them that in markets, certainty is always the most dangerous trade of all.